Hello and welcome to this week's lecture on finance and the banking system. The primary goal of the financial system is to pair people who have money available to lend with people who have uses for that money today. So if I have money that I wish to save and don't need to spend into the future, I can lend my money to people who want to invest in starting businesses or build houses or buy cars or things that they need to borrow money for today. So the financial system pairs lenders and borrowers. In financial markets, borrowers and lenders can directly connect with each other. I can buy and sell stock, for instance, or I can buy and sell bonds, for instance, directly between borrowers and lenders. Most of financial lending, however, happens between financial intermediaries or through financial intermediaries such as banks or mutual funds, where I put my money into a bank and the bank finds the person who is interested in borrowing it. When we talk about things to finance investment, we're usually talking about two pieces. The first one is debt, and debt is borrowing. If I want to borrow something to take out a loan with an express intention to pay it back, this is borrowing. This is debt. The other side is equity. In equity, we take an ownership stake. I can give money to an investment project, and I get an ownership stake back in that. You can think about this even in the context of a home. I buy a house with a down payment, that's my equity, and I take out a mortgage, that's my debt, to finance the rest of the purchase. And over time, I contribute more of my money to pay down the principal balance, building up my equity, and paying down the debt. For corporations, the primary form of debt is what's called bonds. Companies issue bonds, and a bond is an obligation to pay the bondholder a certain amount of money at a certain specified time in the future. There's usually two pieces to a bond agreement or a debt agreement. The first one is the principal. If I lend you $1,000 and you agree to pay that back at some point in the future, the $1,000 is the principal. The other component is interest. Usually bonds are associated with interest payments where you agree to pay me not just the $1,000 that I lent you, but also an interest, say 10% interest. So you pay me in 1 year the $1,000 principal plus 10% equals $100 more in interest. Bonds differ across a number of different dimensions. Most notably, they differ on the interest rate. Different bonds can charge different interest rates. They also differ in terms of the length of time between when the money is lent and when it needs to be repaid. This is known as the term. They also differ in terms of credit risk. The credit risk represents how likely you are to get repaid. Lending money to a big stable corporation is likely to be very likely to pay. Lending money to somebody with a more sketchy credit history, somebody who's way in debt already, and we saw lots of examples of this during the mortgage crisis a few years ago, where banks lent money to people who are very high risk borrowers. The difference in credit risk is going to affect the terms of the bond obligation. And then finally, bonds differ in terms of their tax treatment. Municipal bonds in particular usually pay interest tax-free, when in most cases interest is taxed to the owner of the bond. Equity in companies usually comes in the form of stock. A stock represents a claim of ownership against the company. So if I own a share of stock in a corporation, I have a part ownership in that corporation, and this gives me a claim against the future profits of the firm. In general, stocks are a little bit more risky, or maybe a lot more risky than bonds, but they also carry a higher expectation of return, a higher expectation of earning large amounts in the future. This is because when a company issues both stock and debt, equity and debt, to finance its operations, the legal obligation is to pay the bondholders back first. So if I need $100,000 to start a business and I collect $50,000 from shareholders who take an equity stake in the company and collect $50,000 in a bank loan, if I make money, the first people to get paid back are the bondholders, the people who lent me the money. But they're capped. capped. They're going to get back their principal and their interest, and that's it. If the company doesn't make much money, the bondholders are the first ones to get their money back. But if the company makes a lot of money, then the shareholders can get far more in return than the bondholders ever could. The bondholders are capped. So equity has a higher probability that it won't see any return, or that it won't get what you expect, but it also has a much higher probability. In fact, it's the only source of financing that has a probability of cashing in on a very big upside. If the company makes 10, 15, 20 times as much as you think it might have, the equity holders are going to see all of the reward. There are some important measurements when we think about stocks, when we examine a company that are worth mentioning here. The first one is to consider the price-earnings ratio. The price of the stock tells you how much it trades for in the open market. So if a stock is selling for $50, I can buy and sell shares of that company for $50. The earnings refers to, well, how much money does the company make in profits? And if it's making, say, $5 a share and it's selling for $50 a share, then the price-earnings ratio is 50 over 5 equals 10. A stock that has a high price-earnings ratio, in other words, if it's selling it at, say, 50 times earnings compared to a company that is selling at 10 times earnings, is a company that investors expect to do well in the future. A high price-earnings ratio indicates optimism about the company from investors. The dividend. Companies can do two things with their earnings. Thing number one is they can leave it in the company to finance other expansion or projects or things like that. And thing number two is that they can pay it out to their shareholders in the form of dividends. If our $50 stock earns $5 and decides to pay $2 of those dollars out to its shareholders in terms of dividends, then it has a dividend yield of $2 per share divided by the price, $50 per share, which is a 4% dividend yield. The market capitalization of a company is the number of shares outstanding times the price of the share. So our $50 stock, if the company has 1 million shares outstanding, then we can say that 50, the price, times 1 million, the number of shares, equals $50 million. That gives us an expression for what the company is worth, what the company's value is.